India's retail inflation has eased to 1.54% in September. It's the lowest over 8 years, down from 2.07% in August. Now, this is bringing some relief to consumers and also signals easing pressure on household expenses. But does this dip signal a sustained trend, or is it a temporary relief driven by short-term factors? To unpack the implications for the coming quarters, and especially in the context of whether there will be more rate cuts, I'm joined by Gaura Sengupta. She's Chief Economist at IDFC FIRST Bank. Gaura, thank you so much for speaking with us this morning. Just the contradiction that core inflation has actually gone up while the headline numbers are down. How do you see that? Let's start there.
So thank you. So the pickup in core inflation is twofold. One mainly is gold prices, the surge in gold prices, which has led to a pickup in core sustained over the last several months. More recently, and specifically to the September month, the increase in core, there's also been slight pickup that we are seeing in housing inflation, which has gone up to a 2-year high. So, but I wouldn't read too much into the pickup of housing inflation. Housing inflation post-COVID has been incredibly low as per the CPI data. Well, anecdotal, we've had indications that we've seen a much stronger pickup in rents. So some part of this could be catch up. We'll have to see. This is the first month that you're actually seeing that the month-on-month increase in housing inflation is a bit higher than what the seasonal pattern for the month of September. But mainly the pickup in core is reflecting gold. So if I remove core inflation, it's very low. Core inflation is nothing but core inflation. You remove gold, silver, petrol, diesel. It's very low at around 3.1, 3.2%. And it's been around these ultra low levels for the last almost 2 years, which indicates that the economy is growing below full potential. So there is excess capacity. As a result, core has sustained at a low levels. The other thing is food inflation, which turned more negative in the month of September due to decline in vegetable prices, which definitely helped the headline. To answer your question on sustainability, this looks like a sustainable trend. Yes, a large part is due to food, but if you look at core inflation, you remove the impact of gold, it is also telling us that there is excess capacity. So there is no demand pressure on inflation with the economy growing below potential. So this is a sustainable trend. In fact, our full year numbers are tracking at around 2.4% for FY26. Next year is tracking at 3.9%. For FY26, it could be even lower than a 2.4 if the trend in food inflation sustains. It looks like it could be closer. Instead of a 2.4 for FY26, would be closer to maybe around 2.2-ish%. So definitely sustainable. We are seeing it even into next year at softer than averaging around 3.9. So a very sustainable, broad-based moderation in inflation.
Sustainable, it's broad-based. What is the kind of cue it gives the Reserve Bank of India at the next couple of policies? 25 basis point in each of the next two policies is what seems to be the consensus call. Do you agree, Gaura?
I think rate cuts come in response to growth. It doesn't come in response to inflation. At least from this RBI, that is what we are seeing. For example, the governor very clearly stated in the October policy that he sees space to cut rates. This is reflected by, let's say, they're revising down their inflation for FY26 and also a softer print as per them for Q1 FY27. So they are seeing space to cut rates, but he chose to remain on pause for the second consecutive policy. That shows that he is waiting for, let's say, the risk for a better clarity on growth. So if he does cut interest rates, it will be due to growth. If, let's say, the risk to growth, the downside risk to growth become evident. One of the conditions is, let's say, if the 50% tariffs on India sustain till the December policy, and it looks like India is not going to reach a trade deal with the US, then yes, we have space for a rate cut in October. The other condition for a rate cut could be, let's say, they are looking at the demand conditions, especially urban demand, which has been weak. And it has remained weak even in Q2, whether in Q3, whatever limited data they'll have roughly one month to 2 months maximum data for the festival season, which is Q3, post the GST cut, to see how urban demand actually responds to festival season, how impactful has the GST cut been to revive urban consumption. If he sees that urban consumption is still weak, then yes, he can cut in December. Inflation is clearly telling us you have space to cut policy rates. You can cut around 1 to maybe a 25 to 50 basis point. There is space to ease. But the rate cut action, that will be driven by growth. So only when he sees downside risks to materialize will the RBI cut interest rates.
Right. Okay. Okay. So I think growth becomes the big question. Inflation now under check. Gaura Sengupta, thank you so much for speaking with us.